Today I'm going to feature two people that are being interviewed, and I've not featured these people before. I think they're highly credible, and I'll explain that later. And they give very specific, fairly specific predictions on what is happening with the market, stock market, this year and beyond. And I will explain this. Hi, I'm Ben Reppond. Today is May 28, 2024. Welcome to my YouTube broadcast. I want to begin, I'm going to play these predictions that are based on, I think, credible analysis. But before I do, I wanted to say something. Three weeks ago, I did a video on the car market, mostly the new car market, and why repossessions were happening so much, or people were turning in their keys and just walking away from their vehicles a lot. And the inventory is building up in the car lots and beyond. And I had a lot of comments, a lot of views and a lot of comments on that video. Two of them I noted were interesting to me, and I thought I would read them to you. If you look up the video, you'll find these comments in there. But they kind of summarize what the point I was making, but maybe even a little more dramatic. But a lot of comments on the video. So one guy said, "My friend is a repo man." Okay, I take that to mean he drives a wrecker and picks up cars and trucks that are being repossessed. Last month, they, which must mean his firm, they had over 300 repos, and a lot of them were $80,000 pickups. Wow. Another one said, "A friend of my daughter just got laid off by her big Chevy dealership she has worked for 4 years. Not just her either." That must mean other people are also being laid off. Cost savings, rollbacks, cars aren't moving. So I think, just to comment on this, that based on what people said and my own analysis, is that cars are being manufactured here and abroad, and they are being pushed out to the dealerships. The dealerships, their lots primarily are full. The cars are not moving. So the cars that they're bringing in are in backup lots. And when I say lot, I mean acres or tens of acres, or I don't know, I mean, just as far as the eye can see, you see these cars stacked up, waiting to go to dealerships that can't take them today. In addition to that, there are electric vehicles, EVs, that are coming in from China. There are some made in the US, but a lot are coming in from China, inexpensive ones, and they're not selling. Most people don't want them, and they just don't want an electric vehicle. They want a gas one or diesel. And the government is pushing those on us, creating incentives for dealers to sell them, probably creating incentives for people to buy them, and maybe even at some point, I think there is a point where they, at 2035, I believe, where they're requiring, if you're going to buy one, you have to buy an EV. So it's just not working. And one of the issues, of course, the EVs, people don't want them. But the other thing, two things. Prices are high. I don't look at cars. I really look more at trucks. But trucks are in the $60,000 to $100,000 range. Maybe 80 is the mean. And secondly, most people finance them because they don't have that kind of money laying around. They just don't have it. And actually, when you look at the repossessions happening, they don't even have enough money for the monthly payments. So they're having to finance them. The financing cost is happening. I don't know what the rate is because they really what they do is if you pay cash for a car, then they have a higher price for the car. They put more what they're going to lose in interest payments. And whatever they have in interest payments is being subsidized. So I don't really know what the real interest rate is, but you know that interest rates are up and that gets baked into the payments. So the average payment for a car or truck is $750. And there are many that are over $1,000 a month. So no surprise that they're being repossessed. So I just wanted to comment on this because of the comments that I got from you. Thank you. Okay, next I want to play this. A macroeconomic strategist by the name of Henrik Zeberg, and he is an economist from Copenhagen. But he's being interviewed by James Connor from Toronto. It's a good interview, and he has some really good insights. Connor has interviewed him before. I've never played one from him, but as I listened to him, listened to his logic and his thinking, it made sense to me. So I agree with him. Is he right? Is this what's going to happen the way he predicts it? We don't know. Even he can't say with certainty, but he believes that his research and his methodology is correct. His prediction in the last time he was interviewed, back in January, he predicted that we would have a strong market and that the market would go up to, S&P 500 would go up to 6,100, 6,200. We're part of the way there, but we're not quite there yet. But he's being pressed on it. He says, yeah, I think we're still going to, I'll just say 6,000 plus on the S&P 500. And then he predicts this year, sometime later this year, again, he's a macro, so I give him a lot of room for this, that sometime later this year, that the market will begin a collapse, a decline that will go for, he says, into 2026. So what that tells me is probably around a year and a half of decline. How much, he doesn't say, but he did say maybe early 26. That would be painful. And I don't think most people are prepared for it because we have been going mostly, now we've had a couple of pullbacks, but not that kind of decline. So when you go all the way back to 2008, 2009, we're kind of accustomed, maybe for the last 15 years or so, to the fact that the market is just going to keep on going up. So I was reminded of you've heard the analogy of the boiling the frog in the pot. And you can gradually cook him to death, basically boil him, by gradually turning up the heat, and he'll stay in there. But if you throw him in the hot pot, boiling, he'll jump out. And I think that's an analogy for us, is that we have become so accustomed to the fact that the market just goes up. And if it goes down some, it goes on back up. It never has gone in, for the last 15 years, gone into a deeper decline for a prolonged period. You could say a little bit 2022 and a very sharp down in 2020 and a quick recovery. But really, that's about it. And those don't really fit the description I'm giving you. I think the market, sooner or later, and I'm not sure this is it. I don't actually think what he's talking about is what I'm referring to. Long term, and I'll say, I'm just going to give myself some room and say over the next 5 years. Maybe it's 3 or 4, I don't know. But I'd say by 2029 for sure, I believe that the market is going down severely. It is going to have a deep crash, and there's called economic or currency reset, the reconciling of all the debt around the world. I think that has eventually got the piper has got to get paid on this, and I don't think it's around the corner. So what he's talking about, I think, would be painful, but not what I'm talking about. What I'm talking about is deeper than that. So, but anyway, I go on. Let me just let you listen to him. I think it's credible. I'm putting together 2 or 3 clips here, and take a listen.
So let's move on now. And I want to get your thoughts on the economy and the financial markets. And the last time we spoke was in early January, so 5 months ago, and a lot has happened since that time. And at that time, you thought you were quite bullish. You said we were in a Goldilocks economy. The GDP was strong, and it still is. Unemployment was very low. Inflation was approaching the 2% target rate, and you were expecting a massive rally in all risk assets, the S&P, the Nasdaq, Bitcoin, followed by a massive collapse in financial markets and all financial assets. And you said the resulting recession would be worse than anything we've seen since 1929. And the S&P at that time, when we last spoke in January, it was around 4,700. It's now around 5,300. So we're still about 15% away from your target. But where do you stand now? What's your take on the economy and also the financial markets?
So the economy right now, if you look at it right now, the economy is strong. And why is the economy strong? It's because, we have the labor market. The labor market is strong. We saw the initial claims coming out yesterday, still very low. That number, we need to see that move up. But we're seeing that the number of open positions are coming down, and especially if you take that in terms of how the number of unemployed. So we're starting to see some deterioration in the labor market, and we're also seeing more which was even more severe, the deterioration amongst the consumer, because the consumer right now is struggling with the high interest payments, and the interest payments is what every time kills the business cycle. So when you have an upturn, you have a bull market, you have an economy that is flourishing, it's always killed by the high interest rate, which the consumer has to pay, and they will then pull back on consumption. And what you start to see now is the credit card delinquencies starting to come up, and they come up with a pace that we have only seen into the financial crisis. So it's actually kind of a two-headed tier here, that you can see that on the surface it looks good, and you see the stock market is up, like what I've also predicted, but we're seeing the deterioration down below, and that is what is going to play out eventually.
So let's go through some of your target prices, okay? And now I want to begin with the S&P. It's currently trading around 5,300. Your target is 6,100. Is that still the case?
61 to 62, yeah.
And can you put a timeline on that?
So my timeline for now is that I see that the recession probably sets in by Q4 this year. Could be October, November, December. And I think the stock market will top out 2 months before that. So that means Q3, potentially October. So, but right now it's August, September. That is my potentially September as the timeline for that. That is the best, I would not call guess, but best estimation based on what I see. There is nothing that tells me that we should go above this. We have on various assets, we start to see weaknesses come in. We start to see weakness in Europe. We start to see weakness in Asia, in the Nikkei, in the Nifty as well. So I think you're going to see the top in the stock market in Asia and Europe setting in before you see in the US, and you're going to see a rotation of capital from Europe, from Asia into the US. So that's why I'm saying I'm not bullish across all markets. I'm bullish the US market at this point. I'm bullish small caps, because I also think there will be a rotation from large caps into small caps as we get into the final phase of this business cycle.
So next I want to play a piece. Adam Taggart is interviewing Tom McLellan. Tom McClellan is from Seattle. I met him in Seattle, and I've met him at the NAME conference, the National Association of Active Investment Managers. He spoke a year or two ago, and I met him there. And listened to him. He is well known for an economic indicator market indicator called the McLellan oscillator. He also produces a report called the McClellan report, which has been produced for decades. And it's now, I think, online, but I think in the old days it was a print copy that you'd get in the mail. But he is regarded as a top market technical analyst. He's been right a lot. He's his analysis is always good, but it's using technical indicators. And so he talks about, now I kind of have in the back of my mind what I'm thinking with what Henrik Zeberg said, and what Tom McClellan is saying is not exactly the same, but it's kind of similar. So the similarities between these two analysts, credible analysts, is not that far off. Now, one's on the other side of the world in Copenhagen, and Tom McLellan's in Seattle, but they're thinking that both of them are a little bit on the macro side. Certainly, Zeberg is, and I think McClellan is too, when you hear his analysis. But they come up with different reasons why. So, Zeberg is talking about the consumer and, interest rates and labor and so forth. McClellan is talking about the correlation between what he's saying and the price of oil 10 years ago. Isn't that an interesting indicator? But it has historically worked out to be a predictor of a declining market. Very interesting. So he unpacks that for us. So anyway, just think of Zeberg and McClellan, of the degree to which they're similar, and there is a degree to which they're not similar, but they're kind of saying somewhat the same thing. Take a listen.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stock markets have had a massive run since November of last year, and all the major indices, the S&P 500, the Dow, and the NASDAQ, have hit all-time highs recently. U.S. GDP growth for the current quarter is currently predicted to be 3.6%. Global economic growth, as measured by PMIs, has turned positive for the first time in 2 years. The official unemployment rate remains below 4%, and the most important stock to the markets, Nvidia, just beat expectations on both earnings and revenues. So it's unsurprising the bulls are feeling large and in charge right now. Talk of hitting S&P 6,000 later this year is getting louder. Is that likely? In heady times like these, turning to the data and navigating by what it's telling us is often highly useful, which is why we're fortunate to have one of the best technical analysts in the industry, Tom McClellan, joining us today to share his latest interpretation of the current market action. Tom, thanks so much for joining us.
One of the things that I'm looking for immediately is an end to this big long uptrend. And the reason for expecting that is that years ago I discovered that the stock market tends to echo the movements of crude oil prices about 10 years later. What I'm showing in this chart is a plot. These are both logarithmic scale plots. Crude oil is on the top, and it's shifted forward by 10 years and compared to the Dow Jones Industrial Average. And you can see that every one of the movements, every one of the major movements anyway, in crude oil gets echoed about 10 years later as a similar movement in the stock market. Now, the magnitude may not be exactly the same, and the timing may not exactly be 10.0 years. It can be off by a month or two, and that's normal. But generally speaking, the movements of crude oil tend to show up again later in the stock market. And that's important because almost 10 years ago, crude oil prices started going through an unpleasant decline. OPEC had been defending crude oil prices against the dilution of prices due to fracking and the shale boom. And they finally decided to give up, and we saw a big decline starting in 2014. Well, you add 10 years to 2014, and we get to 2024, and that's where we are right now. Zooming in a little bit, we see that not the crest, but the ledge that we fell off of in crude oil prices, that was in June of 2014. So if it works out exactly 10 years later, then we would be thinking June of 2024. But it doesn't always work out exactly 10 years later. So for example, this bottom in crude oil prices in November of 1998, that got echoed as a bottom in the stock market in March of 2009. So not exactly 10 years, but the decline was there, the bottom was there, and the rebound was there, all as crude oil had predicted. Sometimes we get an exogenous event like the Iraq War in 1990 and 91, which caused crude oil prices to double. We didn't really echo that double because it was an exogenous event that wasn't really a market event. Similarly, the magnitude of the big commodities bubble in 2008, which crashed down to January 2009, in crude oil prices. That's all. It's echo in the stock market, but in much more miniature form and off by just 1 month from the ideal bottom date. So you don't necessarily take this literally for the magnitude of it, but it's pretty good about the timing of the turns. So I wouldn't necessarily expect that the stock market has to have a decline as big in magnitude as what the crude oil shows over the next couple of years. But it should be an unpleasant time starting this summer and lasting into early 2026 to echo the oil price decline.
And the final piece I want to play is one from Julian Emanuel, who is from Evercore, and he is being interviewed about his analysis on the market. And again, I think this is correct, not inconsistent with the previous two. He is saying the core message is the market is overvalued. No surprise. Now you can look at price. When you look at the S&P 500 over the last year and a half, you can see that it has gone up a lot. So you can tell just from a chart that it is overvalued. Also, the price earnings ratio of the S&P 500 he quotes as being 23.5. 23.5 is a pretty high valuation. It tells me at 23.5 that the market has a lot more downside risk than it has upside opportunity. Now, when you look at Zeberg and McLellan and Emmanuel, you look at these three people, they may all be saying some kind of the same thing. I don't use that as a method to invest money. As a money manager, you have my own technical indicators, but I do think it is instructive, and I think it is in general correct. By the way, people who use things like this to try to determine, market risk, the problem is that it may work on protecting downside risk to some degree, but the key to making money in the market partly is that, but another key is getting invested when the market is exhausted. When the air has come out of the balloon, in my opinion, you want to be invested as close to the bottom as possible. And based on people's hunches of I think this and I think that, usually it's very hard to get invested at the bottom. Some people can do it, but it's hard for a lot of people. But anyway, I play this because I think it does play into the script of what we're talking about. Market being quite overvalued doesn't mean it can't go higher. And as Zeberg and McClellan said, it probably will before it goes back down. But anyway, I think it adds to the narrative. So take a listen.
Evercore ISI's top market forecaster thinks it is the wrong time to go bullish on stocks. Julian Emanuel is the firm's senior managing director. His S&P 500 price target is more than 10% below today's close. Julian, welcome. Is it harder and harder to stick by that forecast as markets go higher and higher?
Well, by definition, it is. There's no question about it. But let's think about it, right? The first 10 minutes of this conversation, we've been focused on valuation. It is something that I would say in the course of years of me being with you all, we've talked about very, very little. But the point being that, whether it's the consideration of earnings estimates that in our view are far too high, even though we had a good earnings quarter, but good earnings quarter was up 5.5%. The market thinks the full year is 10.5%. At 23.5 times earnings, whether it's the premier investment bank stock in the world, or it's the market in general, we just think this is a time to really think about risk reward here. And, Goldilocks, despite the fact that we're either at 2 or 1 or 0 cuts, continues to be priced very aggressively.
Okay. There is a new sheriff in town. He's a bull. And how long are the bulls going to be in charge? We don't know, but we've certainly heard some comments that there seems to still be some more upside to the market. And that's what I think as well. But then it will not last. It will not go forever. At some point, the bulls will get kicked out, and the bears will get back in charge. Thank you for listening. If you have questions or comments, leave them in the comment section below. Thank you.